Imagine doing, the exact right thing to protect yourself.
Right, which we're all told to do constantly.
Exactly. You watch the news, you see the endless headlines about massive data breaches, and you decide, okay, I am not going to be a victim. You take control.
Yeah.
You go online, contact the major credit bureaus, and you freeze your credit file.
Yeah, the absolute gold standard for identity protection.
Every financial advisor, every security expert tells you to do this. But then you go to buy a pair of shoes or maybe pay for a utility bill using one of your favorite financial apps, and suddenly you are locked out. Instantly.
It's just completely bricked.
The app treats you like a criminal. Your card is declined. You call customer service holding your physical ID, knowing you're exactly who you say you are. And they basically tell you, well, there's nothing we can do. You just have to wait for the computer to figure it out.
It is a completely surreal experience. I mean, think about it. You put a heavy-duty deadbolt on your own front door to keep the bad guys out, and the immediate result is that your own house refuses to recognize your key. And you are left standing in the cold, arguing with a machine.
Welcome to the Deep Dive. Today we are looking at what happens when a company that is actively trying to become your entire bank is run by an algorithm that treats human friction as a security threat.
It's wild.
We have our hands on a crazy mix of documents today. We are looking at everything from, pristine SEC regulatory filings that have Wall Street absolutely drooling to raw, furious Reddit threads from locked-out users to this highly forensic lawsuit that completely exposes the underlying machinery of this whole industry.
Yeah, it's a massive contrast.
Okay, let's unpack this. We are going to reveal the hidden automated architecture operating right behind the Pay in 4 button on your favorite websites. Whether you use these apps all the time or you just find fintech fascinating, this is going to change how you see online shopping.
We really are looking at a collision of two completely different worlds here. Because, in the boardroom, the narrative is all about flawless hypergrowth, artificial intelligence, massive profitability.
Right, the shiny stuff.
Exactly. But on the ground, for the actual consumer, the reality is a nightmare of automated bureaucracies, synchronization errors, and a system that is fundamentally unequipped to handle the messy reality of human life.
Because to understand what is happening to the individual consumer, to understand why you might get locked out of your own account, we have to look at the sheer scale of the machine we're dealing with.
Right, the numbers are huge.
We're focusing heavily today on Sezzle Inc., one of the major players in the buy now, pay later space, BNPL, and looking at their Q1 2026 earnings report and their SEC 8K filings. I mean, the numbers are staggering. They're building an empire.
The financials they reported in early May of 2026 are nothing short of explosive. They reported first quarter revenue of $135.5 million.
Wow.
Yeah, that is a 29.2% increase year over year. But top line revenue is only half the story in fintech. Their adjusted net income was $51.3 million, up almost 42%.
Wait, slow down on that. $51 million in net income on $135 million in revenue. That means they are keeping an enormous chunk of every dollar that flows through the system.
Exactly. Their adjusted EBITDA margin, which basically measures their core operating profitability, it hit 52.5%.
That's insane for tech.
It is the holy grail. Most tech companies bleed money for a decade just to capture market share. Sezzle is operating at a massive scale and throwing off tremendous amounts of cash.
And clearly, management feels bulletproof right now. I mean, they didn't just report a good quarter. They actually raised their guidance for the rest of the year, right?
Yeah, they originally told Wall Street to expect 25 to 30% revenue growth for 2026, and they bumped that up to 30 to 35%.
Wow.
They lifted their net income target to $180 million.
But what I don't understand is how they plan to sustain that.
Yeah.
There are only so many pairs of sneakers you can finance in 4 installments, The market has to saturate eventually.
That is the existential problem for every BNPL company, and it dictates their entire 2026 product roadmap. They know the basic pay-in-4 model is becoming a commodity, so they are aggressively pushing beyond checkout loans.
Right.
They are introducing a concept they call agentic commerce.
I saw that phrase in the filings, agentic commerce. It sounds like something out of a sci-fi novel. What does that actually mean mechanically?
Mechanically, it means embedding artificial intelligence directly into the discovery and underwriting phases of shopping.
Okay.
Instead of you going to a website and clicking a Sezzle button at the end, the AI acts as a shopping assistant, pushing personalized product recommendations based on your massive cache of financial and behavioral data.
So it's watching what I do before I even decide to buy.
Right. They are partnering with a company called Pagaya Technologies to embed AI directly into the underwriting process. This lets them approve more people faster and offer longer-term installment loans by predicting default rates with incredible precision.
So they want to guide what I buy and instantly approve the loan for it before I've even decided I want the thing.
Pretty much.
But here is where the roadmap gets genuinely bizarre to me. I'm looking at this announcement for something called Sezzle Mobile. It's a wireless cell phone service.
Yeah, that one surprised a lot of people.
They are launching a mobile plan on the AT&T network for $29.99 a month. I have to push back on this. A buy now, pay later company offering a wireless plan.
I know, it sounds weird.
That is like a car dealership aggressively trying to sell you a weekly grocery delivery service just to keep you coming back to the lot. Yeah. Why on earth do they want to be my phone provider?
It sounds completely disjointed until you look at the underlying data architecture. Sezzle operates as a mobile virtual network operator, or MVNO.
Okay, meaning they don't actually own the towers.
Exactly. They aren't building cell towers. They're just buying bulk access from AT&T and reselling it. The profit margin on a $30 phone plan is razor thin. They aren't doing this to make money off your phone bill.
Then what is the play?
Data and ecosystem lock-in. Think about what a cellular provider knows about you.
Everything, basically.
Right. They have your real-time location data. They have device fingerprinting. They know exactly when you pay your most essential utility bill.
Oh.
If Sezzle controls your cell phone service, they have an impenetrable stream of behavioral data to feed into that AI underwriting engine we just talked about.
So it's all about the data feed.
Exactly. And more importantly, you have to interact with them every single month. You stop seeing them as just a debt vehicle for impulse purchases, and you start seeing them as the foundational utility of your daily life.
The phone plan is basically a Trojan horse to gather behavioral underwriting data, and that completely recontextualizes their ultimate goal. Deep in these filings, they casually drop the fact that they intend to submit a formal banking charter application by mid-2026.
Yeah, they don't just want to be an app. They want to become a real federally chartered bank.
Which is a fascinating pivot because the entire BNPL industry was born out of a desire to avoid traditional banking regulations.
A very deliberate evasion, actually. If you look at the Truth in Lending Act, TIL, and its implementing regulation, Regulation Z, federal law generally defines consumer credit as loans subject to a finance charge or loans payable in more than 4 installments.
4 installments. Not 3, not 5. 4.
Right. By offering exactly 4 installments and claiming to charge 0 interest, instead making their money by charging the merchants a fee, BNPL platforms effectively argued they were not lenders under TILA.
So they completely bypassed this massive web of federal disclosure requirements, interest rate caps, compliance costs.
Exactly. This regulatory arbitrage is what allowed them to grow at warp speed compared to a traditional bank.
But if avoiding regulation was the secret sauce to their hypergrowth, why would they voluntarily walk into the most heavily regulated industry on the planet by applying for a federal banking charter?
Because the walls are closing in on the arbitrage. The Consumer Financial Protection Bureau recently issued an interpretive rule stating that BNPL lenders essentially are credit card providers under KILA, meaning the old loopholes are collapsing.
So the party's over.
Pretty much. Plus, to fund these longer-term loans and physical card products, Sezzle needs cheaper capital. A banking charter lets them take consumer deposits, which is the absolute cheapest capital available.
Right, holding people's cash.
Exactly. It also allows them to preempt a patchwork of state laws and export interest rates uniformly across the country. To survive the next decade, they have to become the very thing they disrupted.
So they are building this massive, all-encompassing AI financial ecosystem and pushing for a federal banking charter. To pull that off, to convince federal regulators to give you a bank charter, you need a bulletproof, flawless corporate foundation. Your governance has to be pristine.
You would think so. But if we dig into the corporate governance section of these sources, that foundation appears to be fracturing under the immense pressure of their growth.
Let's look at the sudden departure of Karen Webster.
Yeah, I saw this. She was an independent director on Sezzle's board, but she wasn't just sitting in a chair. She was on the Audit and Risk Committee, the Compensation Committee, and the Nominating and Corporate Governance Committee.
She held the trifecta of oversight.
She was essentially the watchdog of the board. And in April 2026, right as they were gearing up for this massive banking pivot, she abruptly resigns.
And not quietly either. Right. Usually you read these SEC 8K filings and they say, oh, the director is resigning to pursue other opportunities and spend more time with family. It's boilerplate PR.
Always.
But her resignation letter specifically cited a, quote, growing difference in perspective with management concerning the company's direction, key decisions, and governance. That is incredibly pointed.
It is the corporate equivalent of pulling a fire alarm on your way out the door. When a key member of your risk and audit committees explicitly cites governance disagreements as the reason for leaving, the market takes it very seriously.
I bet.
Immediately after this became public, a wave of class action law firms, places like Pomerantz LLP and Edelson Lexan LLP, announced investigations into potential securities fraud. They are probing whether the board breached fiduciary duties or issued misleading public statements leading up to this.
And if we look backward, it's not like this is the first time their governance has been questioned. They have a history of playing fast and loose with regulatory definitions. The sources detail a major crackdown in 2020 by the California Department of Business Oversight. What happened there?
This goes back to the core debate over what a bnpl transaction actually is. Sezzle's stance was, hey, we aren't making loans. We are simply purchasing credit sales contracts from merchants after the fact.
They were claiming to just be a passive buyer of paper.
Yes. But California regulators looked at the actual mechanics. They saw that Sezzle was deeply embedded in the merchant's checkout flow, providing the payment processing, the marketing, the dispute resolution, and underwriting the consumer directly in real time.
So they were doing all the work of a lender.
Exactly. California applied the Unruh Civil Rights Act and the California financing law, ruling that these were not passive purchases, they were illegal, unlicensed loans.
The regulators basically said, if you underwrite the person, fund the transaction, and collect the money, you are a lender. We don't care what you call yourselves. So California fined them $28,200 and forced them to refund $282,000 in illegal fees to 17,000 consumers.
Right, a significant slap on the wrist.
But I have a question about this. They paid the fine, they got the license in California, and they moved on. Why does a 2020 regulatory spat matter in 2026?
Because it exposes the fatal flaw in their original business model. Complying with 50 different state lending laws, 50 different usury limits, and 50 different licensing regimes is astronomically expensive and creates massive friction.
And their whole thing is frictionless growth.
A company built on frictionless hypergrowth cannot afford to have 50 different compliance departments.
Which explains exactly why they are currently partnered with WebBank. I was reading the legal filings for the Royer dispute, which we're going to get to in a minute, and this entity called WebBank kept popping up. What is WebBank, and how do they solve Sezzle's state regulation problem?
WebBank is a state-chartered industrial bank headquartered in Utah. They operate what consumer advocates critically call a rent-a-bank scheme.
Rent-a-bank. Okay, how does that work?
Here is how the mechanics work. Because WebBank is a chartered bank in Utah, federal banking law grants them the power of interest rate exportation. This means WebBank can legally export Utah's highly permissive interest rates to consumers in any other state, entirely bypassing the local state's interest rate caps and consumer lending laws.
Okay, let me make sure I have this analogy right. It is essentially like having a friend with diplomatic immunity.
Okay, let's hear it.
You want to bring illegal fireworks across state lines, but you know you'll get pulled over. So you have your friend with diplomatic immunity drive the car across the border, and once you are safely in the new state, he just hands the keys back to you.
That is a surprisingly accurate way to describe regulatory arbitrage. When you click buy on a long-term Sezzle loan, Sezzle doesn't technically make the loan. WebBank originates the loan to you, utilizing its special banking powers to ignore your home state's laws.
And then what?
Then, almost immediately, sometimes within days or hours, WebBank sells the loan receivables right back to Sezzle.
It's a total sleight of hand. WebBank rents out its charter so fintechs can operate nationwide with a uniform product, avoiding local state consumer protections.
Exactly. And while it is technically legal, it is highly scrutinized. When you combine this complex regulatory maneuvering with the sudden resignation of a risk committee director, it paints a picture of a company where the tension between relentless growth and basic compliance is reaching a breaking point.
And that tension is bleeding directly down to the consumer level. We have a Hindenburg Research short report in the sources alleging risky financial practices. But more tellingly, if you look at the Better Business Bureau, Sezzle has a rating of 1.1 stars out of 5, based on nearly 1,000 complaints over the last 3 years.
Wow, Ouch.
I don't know if you've ever tried to get a 1.1 star rating on the internet, but you really have to actively, systemically infuriate people to achieve that.
You do. And the BBB complaints are incredibly consistent. It's not just people annoyed about late fees.
What are they complaining about?
Consumers are documenting aggressive collection tactics using third-party agencies, hidden fee structures, and, most importantly, a complete and total inability to resolve basic disputes with a human being.
There's, again, no humans.
Right. A system optimized entirely for rapid origination and revenue growth is fundamentally unequipped to handle customer service when something breaks.
Which leads us perfectly into exactly how things break. Because this tension doesn't just happen in SEC filings or boardrooms, it plays out on the smartphones of everyday people. And to see what that algorithmic nightmare actually looks like, we are going to dive into the Sezzle community on Reddit.
The Reddit threads are phenomenal qualitative data. They give us a real-time diagnostic of where the API middleware, the actual digital plumbing of the app, is failing.
Let's look at the plight of a Reddit user named ccookie9804. They posted a desperate thread titled, "Can't use Sezzle anywhere, credit file freeze."
Yeah, this one is classic.
Here is their story. They had been using Sezzle without a single issue for 8 months. Perfect payment history. Then, one day, they make a routine purchase request. It goes through the initial approval, but immediately after bam, the app instantly locks their entire account. The screen throws up an error saying their information didn't match.
And when the user finally gets a human on the phone, customer service tells them the system detected that their TransUnion credit file is frozen, and that triggered a hard security lockout.
But wait, this is what makes zero sense. The user explicitly states in the thread that their credit file has been frozen for the entire 8 months they've been using the app. If a frozen credit file is a security violation, why didn't the algorithm lock them out on day 1? Why wait 8 months?
To understand that, we have to look at the mechanics of bnpl automated underwriting. They simply do not ping the major credit bureaus, Experian, Equifax, TransUnion, for every single transaction.
Why not? Doesn't a bank always check your credit?
Traditional banks do, for large loans. But a BNPL company might process millions of $50 transactions a day. Every time a company queries a credit bureau, they have to pay a fee. It might be pennies, but at scale, it destroys their profit margins.
So it's about the cost.
Cost and speed. Waiting for a real-time response from a legacy credit bureau introduces milliseconds of latency, which ruins the frictionless checkout experience.
Right.
So instead of pulling a live credit report, the algorithm relies heavily on internal cached data. Once a user is established, Sezzle evaluates risk based on your repayment history on their platform, the balance of your connected checking account, and behavioral data. A user can coast along for months on a frozen credit file simply because Sezzle's algorithm hasn't bothered to look at TransUnion recently.
It's like relying on an old photograph of a bridge to decide if it's safe to drive across, rather than looking at a live video feed. They just assume nothing has changed to save money.
That's a great way to put it.
So eventually, after 8 months, the algorithm decides it's time for a periodic risk audit. It pings TransUnion, hits the deadbolt of the credit freeze, panics, and locks the user's account.
Exactly.
The user thinks, okay, annoying, but fixable. They log into TransUnion, instantly lift the credit freeze, call Sezzle back, and the representative says, nope, our system still says you are frozen. And this goes on for 72 hours. If TransUnion says it's unfrozen, why is Sezzle seeing a frozen file?
This is the critical failure point of fintech API middleware. It is a severe synchronization lag.
How does that happen?
When you log into TransUnion and lift a freeze, that update happens almost instantaneously on TransUnion's native internal servers. But Sezzle does not have a direct real-time pipeline into the core of TransUnion's mainframe. Fintechs use intermediate API hubs, think of data aggregators or middleware services, to pull this data.
A middleman.
Right. And to save computing power and money, these intermediate hubs often update their records in batches. They might only sync with TransUnion once every 24 or 48 hours.
So the user's holding their phone, looking at TransUnion saying unfrozen. But Sezzle is looking at a cached snapshot on a middleware server from 3 days ago that still says frozen.
Precisely. And because Sezzle operates as a low-cost, hyper-automated platform, the frontline customer service agents simply do not have the administrative clearance or the technical tools to manually force a real-time live credit pull to override the cached data. The agent can only see what their dashboard tells them.
I want to read some of the replies in this thread because it proves this isn't an isolated glitch. A user named Rockerime12 chimes in and says Sezzle admitted to them it's a widespread issue and just told them to wait.
Yeah, that happens a lot.
Another user, Drunken Monk 81 says they have been locked out for 10 straight days. 10 days of actively verifying with TransUnion that their file is clear, but Sezzle's system just keeps spitting out an automated email saying, we don't have a timeline, wait for the system.
10 days is brutal.
It's like you're standing outside a club, and the bouncer's ID scanner is malfunctioning. You are holding your real, valid government ID right in front of his face. But because the little red light on his scanner beeped, he throws you out into the alley.
Yeah.
And when you ask to speak to a manager who can just look at the ID with human eyes, the bouncer just shrugs and says, computer says, no, we don't have human managers here.
It is the dark side of automation. When an algorithm encounters an edge case, it wasn't programmed to handle elegantly, like a delayed API handshake. It lacks human judgment. It defaults to the most risk-averse action mathematically possible, which is to freeze the account entirely and reduce the consumer's spending power to zero.
So it's protecting itself at the consumer's expense.
The algorithm protects the company at the expense of the user's reality.
But this raises a much bigger question about why Sezzle's system is so rigid in the first place. To understand these Reddit lockouts, we need to dive into the actual mechanics of a credit freeze under federal law, because there are different ways to protect your credit, and they trigger very different responses from lenders.
Exactly. This requires a brief look at the Fair Credit Reporting Act, or FCRA. It is crucial to understand the legal and mechanical difference between a credit freeze and a fraud alert.
Okay, let's break that down.
Under the FCRA, consumers have the absolute right to place a security freeze on their credit report. A freeze is a hard binary block. It legally prohibits the credit bureau from releasing your credit report for new accounts. If a lender's automated API tries to pull a frozen file, the bureau's server just returns a hard rejection code. Nobody gets in.
Right, it's the deadbolt. But what about a fraud alert? A lot of people put fraud alerts on their files if they lose their wallet, but they don't want the hassle of a full freeze.
A fraud alert is entirely different. A fraud alert does not block access to the credit file. It allows the lender to successfully pull the report, but it legally attaches a giant red flag to the data file. Crucially, under the FCRA, if a lender pulls a report and sees a fraud alert, they are legally required to take extra manual steps to verify the identity of the applicant before extending credit. They are mandated to call the phone number listed on the alert or request physical identity documents and verify the person with human interaction.
And right there is the massive friction point. We just spent the last 20 minutes talking about how Sezzle is a highly automated, low-cost platform. Their entire value proposition to the merchant is frictionless checkout. If I have $100 worth of clothes in my online cart, I expect Sezzle to approve me in 400 milliseconds.
Precisely. Manual verification destroys the fundamental unit economics of a frictionless BNPL app. If an algorithm hits a fraud alert, Sezzle suddenly has to pause the transaction, pay a human risk agent to call the consumer, review a scanned driver's license, and manually clear the flag.
Which costs them money.
That requires a massive, expensive human support infrastructure that Sezzle does not want to build.
So mechanically, how does Sezzle's underwriting engine handle a fraud alert?
Because they refuse to incur the cost of manual verification, the system appears to be configured to default to an immediate account lockout when it encounters a fraud alert or a data mismatch. It is cheaper for the company to lose the transaction and completely infuriate a longtime customer than it is to pay a human being to legally verify the identity.
The tragic irony here is just staggering. Think about this. If you are listening to this and you have put a freeze or an alert on your file, you are exercising your federal right to protect yourself from identity theft. You are being a responsible digital citizen.
Right.
And Sezzle's algorithms are structurally designed to penalize you for it. They treat your active protection as a security threat because your protection requires human friction and the machine hates friction.
It is a systemic algorithmic punishment for basic security hygiene, and it raises an incredibly uncomfortable question for all of us living in a digital economy. If locking your front door means your own digital bank refuses to let you in, then the foundational architecture of our financial system is deeply, perhaps irreparably flawed.
And that flawed architecture is about to be put to the ultimate stress test. Because if a simple, intentional protective credit freeze completely breaks Sezzle's automated system, what happens when actual malicious identity theft occurs?
It gets really messy.
This brings us to the centerpiece of our documents today, the case of Royer v. Fintech. This isn't just an algorithmic annoyance on Reddit. This is a severe, multi-jurisdictional legal and financial nightmare.
The Royer documents provide a forensic, step-by-step autopsy of a systemic breakdown. It outlines a sprawling dispute involving Dr. Benjamin Royer, his traditional bank Capital One, Sezzle, and their rent-a-bank partner, WebBank.
Walk me through the timeline here. How does this nightmare actually start?
According to the sworn affidavits and timelines in the documents, in early 2026, there was a significant data breach at a telemedicine platform called Open Loop Health. Following that breach, sophisticated identity thieves acquired Dr. Royer's highly sensitive personal information.
Okay, so they have his data.
They took that stolen identity, went to Sezzle, and successfully navigated the automated underwriting algorithm to open a fraudulent BNPL account in his name.
And because it's a buy now, pay later platform, they didn't just walk into a store and buy one $3,000 television right.
Yeah.
That might have tripped a fraud wire.
Yeah.
How did they use the account?
They used a feature called the Sezzle Anywhere Virtual Card. It functions like a digital credit card on Apple Pay or Google Pay. The thieves linked this fraudulent Sezzle account directly to Dr. Royer's actual real-world Capital One checking account.
Oh, man.
Between January 2nd and April 6th of 2026, the identity thieves initiated 105 separate unauthorized transactions.
105 transactions.
In 3 months?
Yes, they were small, automated ACH debits, automated clearinghouse transfers, siphoned directly out of his checking account by Sezzle, acting to collect on the loans originated by WebBank. The total amount stolen over those 105 transactions was $2,807.59.
Okay, so eventually Dr. Royer looks at his Capital One checking statement and realizes his money is evaporating in tiny chunks. What does he do? He executes a textbook, flawless response to identity theft. He doesn't just call customer service and complain. He discovers the fraud in late March. He goes to the Federal Trade Commission and files an official, legally binding identity theft report. We have the text of this in our sources, FTC report number 2006-90442. He signs it under penalty of perjury, which carries federal prison time if he is lying.
Right. It's the highest level of civilian documentation you can get.
Exactly. He also files police reports with his local municipal authorities. He drafts sworn, notarized affidavits explicitly declaring that he did not open the account, he did not authorize the virtual card, and he did not make those 105 payments.
He's doing everything by the book.
He then takes this mountain of gold standard federal and legal documentation and submits it to Capital One, to Sezzle, and to WebBank.
Wait, hold on. This shouldn't be a story. This shouldn't be a massive legal dispute. I've had my credit card stolen before. I noticed a weird charge from another state. I called the bank, gave the police report number, and they reversed the charge in 10 minutes.
Yeah, that's how it used to work.
Right. If Royer provided an FTC report signed under penalty of perjury, why are we even talking about this?
Yeah.
Capital One should have just handed him his money back. That's what a bank's fraud department is for.
That is exactly how it worked in 2005. And under the Electronic Fund Transfer Act, or EFECO, a consumer is absolutely protected from unauthorized electronic transfers if they report them in a timely manner. You provide the proof, the bank investigates, and they restore your funds.
So what went wrong?
That is not how modern dispute resolution works when fintech middleware is involved. Capital One did not give him his money back. In fact, Capital One initially denied all of Dr. Royer's fraud claims.
How is that possible? Did they think he was lying?
It wasn't that they thought he was lying, it's that they never actually looked at his evidence.
What do you mean they didn't look?
When Dr. Royer submitted his FTC report to Capital One didn't put a human investigator on the case. A human didn't call Sezzle to discuss the police report. Instead, Capital One fed his dispute into an automated legacy system called eOscar.
eOscar? What is eOscar? It sounds like a defunct 1990s chess computer.
It basically is. eOscar stands for Online Solution for Complete and Accurate Reporting. It is an automated clearinghouse system that credit bureaus, banks, and lenders use to communicate about consumer disputes. It processes something called Automated Consumer Dispute Verification, or CDV.
Okay, lay this out for me.
Here is how the mechanics of a CDV actually work. Capital One's computer takes Dr. Royer's complex human tragedy, the identity theft, the police report, the FTC affidavit, and translates it into a 2-digit alphanumeric code.
Wait, so his multi-page sworn federal affidavit just becomes code 01.
Essentially, yes. Capital One sends that 2-digit code through the eOscar network to Sezzle's servers. The automated ping basically just asks Sezzle's computer, hey, does this guy's name, address, and social security number match the account you have on file?
But of course it matches. The identity thieves used his real stolen data from the telemedicine data breach to open the account.
Exactly. Sezzle's automated system receives the ping, checks its database, sees that the name and address match the account the thieves opened, and sends a code back to Capital One saying, yes, this is valid, the information matches.
And then what?
Capital One's automated system receives that confirmation and instantly, mechanically denies Dr. Royer's claim. Human eyes never looked at the FTC report. The bank just relied blindly on an automated ping from the very company that was withdrawing the fraudulent funds.
That is maddening. It is literally two robots high-fiving over stolen money while the victim is waving a police report in the background.
It really is.
But Dr. Royer is clearly not someone who just accepts a bureaucratic denial. The documents show he fought back incredibly hard. He didn't just appeal the decision, he forensically audited the specific data Capital One used to deny him.
He did. And his rebuttal is a masterclass in exposing the absurdity of automated data architectures. Capital One was required to send him the underlying data they received from Sezzle to justify the denial. Dr. Royer analyzed it line by line and pointed out a glaring, fatal anomaly.
What was it?
The fraudulent Sezzle account was actually opened using the official government email address of a Wisconsin state investigator.
Wait, what? Why would identity thieves use a state investigator's email address?
It's highly unlikely the thieves did. What most likely happened is an algorithmic hallucination. When Dr. Royer filed his police reports, a state investigator likely emailed Sezzle to inquire about the fraud. Sezzle's automated system lacking human context likely scraped that incoming email address and erroneously merged it into the master data file for the fraudulent account.
That is so sloppy.
It is, but regardless of how it happened, Dr. Royer uses this bizarre data error to trap Capital One in a brilliant logical trilemma.
Oh, I love a good logical trap. Walk us through the trilemma.
Dr. Royer writes to Capital One and says, look at the evidence you are relying on to deny my claim. Based on the presence of this state investigator's email address on the account, one of three propositions must be true.
Okay, what's proposition one?
Proposition 1. I, Dr. Benjamin Royer, committed a highly elaborate and bizarre crime by impersonating a state investigator, hijacking their official government email server just to open a Sezzle account in my own name to steal my own money.
Which is patently absurd.
Right. Proposition 2. The state investigator used their official government email address to open a Sezzle account and maliciously siphon $2,800 out of my checking account.
Which is completely contradicted by the police reports, the FTC affidavit, and, basic common sense.
Which leaves only Proposition 3. Sezzle's back-end authentication architecture is fundamentally broken. It erroneously merged unrelated data, it cannot distinguish between a victim and a criminal, and therefore, the very CDV evidence Capital One is relying upon to deny my EFTA claims is absolute irredeemable garbage.
Boom. Checkmate. He completely deconstructs the machine's logic. He proves that the automated system is hallucinating data.
Yeah, he really pinned them.
But he doesn't stop there.
Yeah.
He doesn't just want his money back. He goes after the structural integrity of Sezzle and WebBank for systemic federal law violations.
Yes. This is where the liability shifts from a localized identity theft dispute into massive regulatory exposure for the fintech. Dr. Royer conducts a forensic audit of 38 separate Sezzle Truth in Lending disclosures, or TILDs, associated with the fraudulent account.
For those listening, a TILD is the foundational document of consumer credit. If you get a mortgage, a car loan, or a bnpl loan, the lender legally has to hand you a document that says exactly how much you are borrowing, what the interest rate is, and what the final total cost will be.
Correct. Under Regulation Z, which implements the Truth in Lending Act, those federal regulatory documents must be perfectly accurate. Specifically, they must accurately disclose the exact amount financed.
Makes sense.
Dr. Royer proved mathematically that 53% of the 38 Sezzle TILDs issued on this account overstated the amount financed.
How does a multi-billion-dollar company get the math wrong on a federally mandated form 53% of the time?
Because of the chaotic nature of digital checkouts and the rigidity of Sezzle's automation.
Okay, walk me through that.
Let's walk through the mechanics. Imagine you go to an online store. You put $125 worth of items in your cart. You hit the checkout screen and click the Sezzle button. At that exact millisecond, Sezzle generates a legally binding Truth in Lending document locking you into a loan for exactly $125.
Got it.
But then, before the transaction finalizes, the merchant realizes one item is out of stock. Or you apply a last-minute $10 promo code. So the merchant only actually captures and settles the transaction for $115.
Okay, so the federal loan document says $125, but the actual cost was only $115. Shouldn't Sezzle just generate a new document?
They should, but generating new regulatory documents post-settlement costs computing power, requires complex reconciliation software, and creates friction in their back-end accounting. So it appears Sezzle generates static TLDs at the moment of checkout and simply does not update them after the final merchant settlement.
So they just leave it wrong.
Right. They are systemically issuing false federal regulatory documents. The document says the consumer borrowed $125, but the reality is they only borrowed $115.
And if you multiply that 53% error rate by the millions of transactions Sezzle processes every year, that is a Regulation Z compliance failure of apocalyptic proportions.
Exactly. And Dr. Royer doesn't stop with TILA. He also documents severe violations of the Fair Debt Collection Practices Act, or FDCPA.
Oh, wow. What happened there?
While this entire dispute is incredibly active, while Capital One is investigating, while the FTC reports are filed and acknowledged, Sezzle's automated system kicks into debt collection mode.
Because the algorithm doesn't read police reports.
Right.
It just looks at a spreadsheet, sees missed payments on the fraudulent account, and triggers the collection sequence.
Right. A Sezzle agent, acting explicitly on behalf of WebBank, sends Dr. Royer a premature collection demand. They include the legally mandated mini Miranda warning, the phrase, "This is an attempt to collect a debt, and any information obtained will be used for that purpose." And they explicitly threaten to shut down his account if he continues to file disputes. They even put in writing that Sezzle does not accept disputes by mail, which is a direct, flagrant violation of a consumer's federal rights.
They also completely revoked his virtual card access during the active dispute, which considered a retaliatory adverse action under Regulation Z.
Yeah, they really piled it on.
What this entire saga illustrates so perfectly is what consumer advocates call the triangular dispute loop. It is a game of hot potato, where the liability is the potato and all the guns are pointed at the consumer.
That is exactly what it is.
If you use a BNPL app, you are trapped in a nightmare triangle between the merchant, the BNPL platform, and your own checking account bank. And because of the way these entities use API middleware and automated eOscar pings, no single entity is willing to take responsibility under the Electronic Fund Transfer Act. Capital One blames Sezzle's data. Sezzle blames the initial authorization, and the consumer is left holding the bag.
If you are listening to this and checking your own banking app right now, you absolutely should be. Because if someone opened a fraudulent BNPL account connected to your debit card today, everything we are describing, the robotic denials, the hallucinated data, the automated debt collection threats, would happen to you tomorrow, your traditional banking protections just evaporate in this triangular loop of algorithmic finger pointing.
Which brings us to the absolute climax of this dispute. Because faced with Dr. Royer's airtight, forensic takedown, his indisputable proof of garbage data, his documentation of systemic TILA violations, and his legal demands for a full transaction-by-transaction reconciliation, how does a multi-billion-dollar company respond?
They make the evidence disappear.
Wait, what do you mean?
On May 18th, 2026, Sezzle's compliance department sends Dr. Royer a final response. They agree to waive the entire outstanding balance of the fraudulent account. They think that no remaining financial obligation exists. They request complete deletion of the trade lines from all credit bureaus, and they permanently close the account.
Wow. So he won. He beat the machine. They gave up and gave him his money.
They capitulated financially, but legally, they executed a brilliant, terrifying magic trick.
Okay, I'm listening.
In that exact same letter, they explicitly and forcefully deny any liability whatsoever. They refuse to admit that identity theft actually occurred. They refuse to acknowledge the TILA violations. Instead, they frame the entire waiver and dilution as a business accommodation.
A business accommodation.
Yeah.
They're basically saying, we are just doing you a solid by wiping away $3,000 in fraudulent charges. We are just nice guys.
Yep. And Dr. Royer, because he understands the mechanics of the system, immediately points out the fatal structural flaw in what Sezzle just did.
Which is?
By deleting the account and erasing the trade lines, Sezzle actively destroyed the very evidentiary foundation that Capital One was using to deny his initial claims. Remember, Capital One was relying on Sezzle's eOscar ping, saying, this account is valid and active. Now, Sezzle has deleted the account and waived the balance, meaning Capital One's denials are legally insupportable. The data they relied on no longer exists.
But because Sezzle refused to actually reconcile which specific payments were stolen and refused to formally admit it was fraud, Capital One is left totally confused. Capital One doesn't know how to process a business accommodation under EFTA rules. So Dr. Royer still doesn't have his actual cash back from the original 105 debits.
Exactly.
Sezzle basically burned the crime scene to the ground, destroyed the fingerprints, and called it a customer service favor.
That is exactly what they did. And our sources introduce a chilling, vital, academic concept to describe this exact behavior. It's detailed in the Bond Bridge working paper, and it's called the governance architecture of invisibility.
The governance architecture of invisibility. That sounds like an espionage thriller, but it's actually about corporate compliance and legal evasion. Break that down for me.
The paper argues that consumer dispute suppression in the fintech industry isn't just a series of accidental customer service failures or bad algorithms. It is a deliberate structural governance choice. The architecture of the company is designed to produce invisibility.
How does a company legally rationalize making a massive dispute invisible?
You have to look at the incentive structure from Sezzle's perspective. If they formally admit in writing that Dr. Royer's account was fraudulent, they are legally required to file specific suspicious activity reports.
Which flags regulators.
Exactly. If they formally admit that 53% of their tildes are mathematically inaccurate, they trigger massive enforcement actions from the CFPB under the Truth in Lending Act. If they officially trigger an internal FCRA investigation and discover their own authentication data is hallucinating state investigator emails, they face millions in regulatory fines.
So it's all about avoiding the paper trail.
Exactly. So instead of investigating, instead of fixing the root cause, they just issue a goodwill waiver. They swallow the financial loss of the fraudulent balance, which is pennies to a company making $135 million a quarter. They delete the account and they sweep the entire mess under the rug.
Let's make it vanish.
By making the dispute disappear, they avoid triggering any formal federal enforcement actions. They protect their pristine regulatory standing at the absolute expense of the truth.
Because if a federal regulator comes knocking next year while they're applying for their banking charter, Sezzle can just open the file and say, what dispute? Look, the balance is zero, the customer's account is closed, we accommodated them, we have a 100% resolution rate. Nothing to see here.
Exactly. The system is economically optimized to suppress complex disputes before they metamorphose into regulatory liabilities. It is the architecture of invisibility. And remember, Section 1 of our discussion. For a company that is actively, aggressively trying to secure a federal banking charter by mid-2026, keeping a spotless regulatory profile is an existential requirement. They simply cannot afford to have a systemic fraud failure or thousands of TILA violations on their public record while they are asking the government for the keys to the banking kingdom, so they vaporize the problem.
This is incredible. Let's take a breath and pull all of these threads together because the picture it paints is stunning.
It really is.
We started this deep dive looking at the pristine, highly optimistic narrative of Sezzle's SEC filings. $135 million in revenue, massive 50% profit margins, AI shopping assistants driving your purchases, and the ultimate ambition to become a full-fledged federal bank. Wall Street looks at that and sees a golden goose.
But as we followed the actual data architecture down to the consumer level, we found a foundation severely cracked by hypergrowth, rent-to-bank regulatory arbitrage, and automated rigidity.
We saw everyday Reddit users, people who are just trying to do the right thing by protecting their identities with credit freezes, getting instantly locked out of their own financial lives because the algorithms treat human friction as a threat. We saw the tragic irony of a system that actively punishes you for practicing basic digital security hygiene.
And we saw the ultimate, terrifying culmination of this automated architecture in the Royer v. Fintech case. When actual identity theft occurs, the legacy dispute systems like Capital One, relying on ancient eOscar CDV pings, fail completely. They rely blindly on automated codes from the very fintechs that are compromised, removing human judgment entirely from the equation.
We saw a consumer forensically expose systemic violations of federal law, proving the machine was hallucinating data, only to have the fintech company utilize the architecture of invisibility to burn the evidence, waive the balance under the guise of a favor, and deny liability, leaving the consumer trapped in a bureaucratic void where the truth simply ceases to exist on paper.
It is a stark, vital reminder that the modern financial technology landscape is a system optimized entirely for speed, scale, and unregulated profit. It is fundamentally unequipped for friction, fraud, or the nuance of human reality.
So, the next time you are shopping online and you are tempted to click that frictionless, easy Pay in 4 button, remember the vast machinery operating in the milliseconds behind your screen. You are not just financing a pair of shoes. You are engaging with a massive, highly automated legal apparatus that operates largely outside traditional banking guardrails. An apparatus where the algorithm is the judge, the jury, and the executioner of your spending power.
And it leaves us with a lingering, deeply provocative question to consider as this industry continues to rapidly evolve. We know Sezzle and BNPL platforms like it are currently seeking formal banking charters. They want to move inside the traditional banking system.
Right. They want the charter to lower their capital costs and bypass state laws entirely.
But if they successfully acquire that charter, what will happen to the ecosystem? Will the strict, rigorous regulations and the heavy oversight of traditional banking finally force these fintech companies to grow up? Will it force them to build human-centric customer service infrastructures and actually protect consumers? Or, much worse, will the BNPL architecture of invisibility, the automated dispute suppression, the algorithmic lockouts, the deliberate burning of the crime scene infect the traditional banking system? Will we see a future where it becomes structurally impossible for anyone to ever get a fair, human-led dispute investigation again, simply because the entire global financial system has adopted the fintech model of vaporizing problems?
That is a terrifying thought to mull over. Think about that the next time you check out online. Because at the end of the day, you can do everything exactly right. You can monitor your accounts, you can file the sworn police reports, you can even put that heavy-duty deadbolt on your own digital front door. But in this new automated economy, you might just find that the diagnostic machine is fundamentally broken, the landscape is entirely murky, and the very system you thought was there to protect your house is the one locking you out in the cold. Thanks for joining us on this deep dive.